Hello, and welcome to today's episode of the Macrocast. I'm your host, Ylan Mui, and Managing Director at Penta. My co-hosts are Brendan Walsh and John Fagan of Markets Policy Partners. But really, we're just the second banana today to the real star of the show, which are the latest jobs numbers from the Labor Department. The economy added 199,000 jobs in October, beating expectations. The unemployment rate actually fell to 3.7%. Brendan, healthcare once again led the way in job growth, along with, perhaps surprisingly, government hiring. What did you see in the numbers?
Yeah, that was really interesting part. It was kind of a bit of a tale of two stories here when it came to the employment establishment data. So that's where, the companies send you, this is how many we hired. So private education hired a lot. That was 99,000. And then healthcare and social assistance hired 93,000. Those were the ones that were massively affected by the pandemic, and a lot of people quit and went away. So that's a really good sign, both for our school systems and our healthcare. But then when you look at wholesale trade, that lost 38,000, retail trade. Leisure and hospitality only added 12,000, and then also, non-durable goods lost 8,000. So there are kind of not necessarily huge weaknesses in the economy, but the ones that had hired a lot during the pandemic, and now you're kind of seeing the consumer not necessarily fall off a cliff, but pull back. You bought a lot of stuff the last couple of years, especially with the government assistance. Those sectors are kind of, finding their footing, and they just don't really need quite as many people as they did. Also, we're kind of seeing small amounts of layoffs, but the sectors of the economy that were really, really negatively affected, we're seeing people coming back. So overall, it's very good, but it's definitely, if you want to nitpick, you can see some weaknesses. And if you want to just kind of look at it holistically, it's a pretty good jobs number. And then when it comes to the unemployment rate, so that's a survey, and so they're collected differently. So that you have to look at them, side by side. They tell somewhat a similar story, but month to month they can be, a little quirky. But the biggest story of that was the civilian labor force increased by 532,000 people. So people are coming back into the labor market, which was always a good thing. So that one registered 747,000 people were employed, and and then the civilian labor force increased too. So when you add those together, that also, because more people got jobs than entered the workforce, the unemployment rate dropped to 3.7. And most, encouragingly, it was in sectors that, have been kind of left behind. Minorities and women over 20, their unemployment rates dropped, and also teenagers are coming back to the workforce, which we didn't see that really at all. It had started to decline before the pandemic, and then it basically ended. Kids just didn't really go back to work. So overall, it kind of shows that the labor force is still doing fine. The wage growth was 0.4, so overall around a 4% increase in wage growth. But we got productivity data earlier this week, which was, at 2.6%. So overall, that's kind of painting a story that, inflation is kind of getting back to where it was around, 2%. So if you're the Fed, I think this is an encouraging story. It's not so strong that you have to freak out, but it's also not weak enough that you have to worry, we're falling into recession and we immediately need to cut. So this is timely data.
Yeah. Was there also distortion around the end of the strikes? There was a sense that would...
Those people came back into the workforce. So another, if you want to, kind of look at it more negatively, you can subtract probably 60,000 people from this number because they were kind of employed.
And that's the end of the automaker strikes. The automakers going back to work, going back to the plants.
Yep.
Yeah. No, I thought it was super interesting. You bring up the labor force participation rate because, one of the questions, and maybe this is part of the virtuous cycle of a strong labor market, but one of the questions have been, how many more people are really on the sidelines, right? We've seen a lot of folks already come back into the labor force, but,
exactly.
532,000 people coming back in. I mean, that's a pretty substantial number. And maybe they're coming back because they're seeing that companies are still hiring. You can still find a job.
Yeah, definitely. And like this shows certain sectors are pulling back. So Walmart is not doing the huge retail Christmas hiring. But if you want to be a teacher, if you want to go work in a hospital, they'll take you tomorrow.
Yeah, I thought the retail trade number was also surprising to me, considering that we're in the thick of the holiday shopping season. So, but I guess in these numbers, I guess we should say these are these numbers seasonally adjusted. So
yep.
Yeah, so they've hired less than they would normally, right?
Exactly.
Even though they're hiring more than they did over the summer in order to account for the influx of holiday shoppers. But I wonder.
Yeah, and just for conspiracy theorists, the BLS does report the unadjusted numbers, so you can look at both of them.
Okay, good to know. But I wonder what that says too about at least what retailers are thinking about consumer spending.
Yeah. And it was kind of previewed in the earnings season. The big box retailers said, the consumer's behaving a little weird, which is also kind of expected, where we did something that we've never done before in 100 years. We locked ourselves in our houses and we got checks and we bought a bunch of stuff. So it's not unexpected. The Walmart CFO was talking about it a couple of days ago. They're definitely kind of pulling back on luxury items and focusing on, kind of the core family purchases. So overall, their sales are still fine, but they're not seeing the huge ramp up in the holiday spending season that they had seen the last couple of years. Thus, they don't need to hire all the extra workers that they had in the previous couple of years.
John, what are we seeing around wage growth? It looks like wage growth for the past year was up 4%. That seems like a pretty strong number and maybe a little bit of an acceleration compared to where we've been at for the previous months.
Yeah, the average hourly earnings month on month was a little bit of an upside surprise. It was supposed to come in maybe a little bit stronger at 0.3%. month on month after the October's 0.2%, but it came in at 0.4%. And these, month on month changes obviously get magnified. So that's the strongest pace I think it's been in a while. I don't know exactly how many months it's been since we've had a reading that high, but that goes back to the point that Brendan is making. This report is, in broad brushstrokes, this is a good jobs report, but it's also a Rorschach test, right? It's like that ink blot, you can see what you want to see in it. And if you're looking for, an inflationary impulse that is a little bit stubborn and hard to go away, that's the kind of place you might look at the acceleration in average hourly earnings and, the lower unemployment rate. And, if you're looking at if you're taking the more sort of, a softer inflationary view, then it's going to be, you're going to be focusing on the overall trend, which is, there's a little bit of upside distortions. The overall trend in jobs is, a softer, a little bit more slack in the jobs market. And so, the downward revisions coming into from this report. So the initial knee-jerk reaction in markets was really more about how they were positioned kind of coming into this. You had treasury markets way, way offside, right, for a big number. Now, we didn't get that big, the huge kind of September shocker upside surprise, 300,000 number. That would have really slammed the door on people's fingers. But, this is coming after a month of just storming treasury rallies with Fed fund futures falling all over themselves to price in rate cuts. Coming into this meeting, there was a more than 10% chance priced in for a January start to the rate cut cycle. That's next month.
New year, new policy.
Really yeah. So the reaction in the markets is a decent sized sell-off in treasuries. You get that immediate reflexive reaction that got taken back a little bit after people parsed the numbers just as we did and saw that it's more nuanced than maybe the headline, upside surprise. So that really is, we have this dynamic that we know all too well. This sort of good news is bad news. When the market is fixated on Fed easing, good economic news undermines those expectations of more monetary easing from the Fed, and that tends to weigh on equities, at least, in this, very short term kind of reactive phase. So that's what we've kind of gotten today. The Treasury market is beginning to rethink the rate cut expectations, which had really gotten, in our opinion, over their skis. So and this is coming into a meeting next week, as Brendan said, and we've got retail sales data, we've got CPI. This is going to be a very consequential week, probably going to set the tone for the just maybe like in October, when the big non-farm payrolls number for September came in, it set the tone for a monster Treasury sell-off. And then we got a downside surprise from the October number at the beginning of November, and a more dovish sounding Fed meeting, which set the table for a big storm and rally in Treasuries. And so, right, we've sort of got this image of people running from one side of the boat and it starts to tip, and then they run to the other side of the boat and it starts to tip the other way. There's got to be some sort of, maybe the Fed gets a steadier hand on the tiller in their messaging in this upcoming meeting.
That analogy reminded me of when I took my daughter to King's Dominion, and, she did that ride where the boat swings wildly from one side to the other. But then at one point, I'm not sure if they're supposed to do this, but they actually made the boat swing all the way around. So at some point, we may even end up in upside down land, right? Where the Fed just comes full circle. So that would be something to see.
Well, 2024 is going to be a wild ride, and we may all end up upside down next year. It remains to be seen.
One thing, though, that I'm trying to square here is that wages are going up, people are finding jobs, but consumers, what we've seen in the retail sales numbers, what we've seen from retail earnings, still seem to be pulling back. And I'm trying to figure out why that is. And I know we can talk more throughout this episode about, sort of consumer sentiment, consumer feelings, et cetera. But I wonder, Brendan, if you sort of alluded to it a little bit, in which you said there was a period where we were all sitting at home getting checks from the government, right? So the stimulus phase has ended. We're now seeing wage growth, but that wage growth isn't happening as dramatically or as quickly as we saw the stimulus phase out.
Yeah, that's a really important point, because the stimulus just kind of fell off a cliff, right? And then the checks just stopped, and then you're on your own,
right?
And then you put with that, you had some economic headwinds. You had the student loan payments started coming back and things like that, but people still have jobs. So all in all, the consumer is still doing fine, especially if you have a job. You can adjust your spending, and I think that's what's kind of happening. We're finding this new kind of balance of, okay, I'm on my own going forward, but I have a job, and you're also seeing a little bit of less of people quitting their jobs to go to new jobs. So the job market's still strong, but it's not free for all, where you can threaten to leave and demand a 20% wage increase. So all in all, I think it's a pretty good scenario for the Fed, where we're not falling off a cliff going to recession, but also things are slowing enough on the wage side that is not only the wages aren't necessarily feeding through to inflation. I think a lot of the inflation drop off is simply the Fed kind of was right, and the Secretary Yellen, that a lot of the inflation was transitory, and it really was due to the pandemic supply chains. That's feeding its way through into the CPI numbers. But the Fed is very concerned, that they're wrong about CPI. So they're not going to fire until they see the whites of the eyes. And obviously, once you transition out of the normalization of the supply chain, you want to make sure that it stays back to normal, and that wages then don't reaccelerate and pick up overall inflation.
Yeah, I mean, if you look over the past 2 years, it's clear that there is a slowing trend, that there's a deceleration in the job market, but sort of how fast that deceleration will occur is unclear and folks are trying to recalibrate on a personal kitchen table level. And so I guess it's no surprise that the Fed would be trying to recalibrate and figure out, how long is higher for longer.
Right. And the sense of the Fed really is that, you've got this wait and see, right? If you're going into a time when there's a lot of uncertainty and the balance of risks is still skewed toward that, the big fear is sort of an echo of inflation. Well, then staying on hold is, particularly if the economy isn't falling off a cliff and is, softening in an orderly fashion, then why would you be in such a big hurry to cut interest rates?
Right. Well, there is a lot more to talk about, but let's take a quick break. And when we come back, we'll talk about why the data seems strong, but public sentiment about the economy is so weak. We'll be right back.
Penta is the world's first comprehensive stakeholder solutions firm. We are a one-stop shop for the intelligence and strategy leaders need to assess a company's reputation and make decisions that improve their positioning. As executives in the C-suite must account for a growing set of engaged stakeholders, all with distinct, fast-changing demands, Penta provides real-time intelligence and strategy solutions. We work with clients solving complex global challenges across a variety of industries. Our clients span technology, financial services, energy, healthcare, and more. To learn more about how Penta can support your company, check out our website at pentagroup.co, our Twitter at pentagrp, or find us on LinkedIn at Penta Group.
Welcome back to the Macrocast. We've been talking about the jobs number and the way the labor market has continued to remain strong despite some expectations. But consumers are somewhat pessimistic still. Households and specifically voters do not have a lot of confidence in the economy right now. The economic sentiment index that Penta produces with our friends at Civic Science has been going up in recent weeks, but it's still lower than it was a year ago when we were really in the crux of the inflationary cycle. And a recent New York Times analysis found that even when you look at voters who support President Biden, a majority believe that the economy is poor or only okay. And the most pessimistic people, this was really interesting to me, guys, are young people and Blacks and Hispanics. 89% of people between the ages of 18 to 29 years old say that they are unhappy with the way the economy is going. So maybe that's one reason why the Biden administration appears to be backing away from what had been one of their favorite terms, Bidenomics. I'm not sure if we even really were able to define what Bidenomics meant. Or maybe depending on what side of the aisle you were on, Bidenomics had a different definition.
Yeah, there was definitely there was a sense that it was a jobs creating dynamic. The Inflation Reduction Act, the bipartisan infrastructure bill, these are really large numbers of fiscal expenditures that are going into real project on the country. And, we've seen this. One of the things that is supporting the U.S. economy does appear to be this, this constant spend through from these large bills. And, this is something that is, I think, bipartisan and in terms of the acceptance that it's something that we've really needed. And, different priorities, obviously, but it's, infrastructure. It's hard to infrastructure was something that the Trump administration wanted to do. And so, it's not exactly like it's just Biden, but he certainly, has to take credit for getting it done. Maybe he's not. And I'm sure that his campaign team is upset that they're not getting the kind of credit for getting these bills done. And it's impossible to say, but for these bills, the economy wouldn't be doing as well. You can't prove that. So it's, we've talked about some of these, potential issues that the consumer is facing. Prices have stopped going up as much, but they haven't come back down. It's still very expensive to go to hotels and to eat out much more than it used to be. You still have these like service charges that are everywhere. And that is, that is obviously, some part of it. Gasoline prices have been high, although they're coming down. We'll talk a little bit more about oil prices a little bit later in the podcast. But, some of it is just who knows what it is? I mean, there's just there's a sense that, in general, the country is on the wrong track. That the polls certainly show that. There's a lot of dissatisfaction. The world is it's a dangerous place these days. To turn on the news, to see headlines, and maybe this feeds through into economic uncertainty. I don't know. You have this general sense of unease and this background radiation of stress that creates this unhappiness, and since the economy is sort of the most important thing in people's lives, maybe that's when they see the economy, their view is through a lens of all of these uncertainties and problems that they see around the world.
I saw an interesting survey the other day, and they just asked people, economic facts, and 70% of the people always chose the negative. And the simple questions like, is the inflation rate higher or lower than it was a year ago? Is the unemployment rate higher or lower than 2 years ago? Things like that. And just people always just think that the world is worse. And they also even ask on a 30-year basis, is it harder to raise a family, today than it was in, the mid 70s and things like that. So there's almost the Biden administration is having a harder time just explaining the realities of the economy, and people are kind of choosing to focus on the negative. And I think, like John said, just the little things, when you go out to dinner, there's an extra charge. It annoys people, and that kind of feeds through to everything that you see as going on in the economy, when the reality is the economy is actually pretty good. I also think that they made a huge mistake calling it the Inflation Reduction Act, because they're not getting any credit for the infrastructure build that's happening. And also all the inflation reducing efforts haven't started yet. That was very much, with the Medicare and Medicaid prescription stuff, which is now happening. So I think they did a bad job of marketing themselves.
Yeah, that's certainly one challenge. I mean, Republicans have used the term Bidenomics to refer to the fact that inflation is still not at 2%.
Exactly.
Right.
Yeah,
so you're owning every dip and valley of the economic data by using the phrase Bidenomics to describe, what was essentially industrial policy and government spending. Right. The other challenge that I see here is that the legislation that you mentioned, John, like the Inflation Reduction Act, like the infrastructure bill, those are long-term generational investments that will take 30 years, decades to pay off. That doesn't help folks right now, right? And so when people are looking at, is the price of milk higher or lower than, where I think it should be, they're feeling that disconnect. Which also speaks to this challenge of explaining the difference between disinflation and deflation. And folks find that hard to wrap their minds around. They just see that prices are still going up. Yes, prices are still going up. They're just not going up at as fast a clip as they used to be. And that's not a very salient political message. So maybe that's one reason why they're stepping away from this.
Yeah, it was definitely it was a little bit of roll of the dice, especially when they were kind of coining that term. It was, usually the faith in a soft landing is riding its highest just before the recession starts, right? That's traditionally the recession usually hits like a little bit later than everybody expects it to, and who knows. The jury's really still out on next year, looking out at the coming quarters. The consensus has gone away from recession calls and has gone to soft landing. And whenever you see having, as Brendan and I know from bitter experience in financial markets, when you have something that's consensus, you better watch out. Consensus has a poor track record, and that really is whether it's financial markets or economics, it's sort of a rule of thumb.
Well, I'm also wondering, I mean, as we talk about Bidenomics and sort of political messaging, et cetera, heading into next year is not necessarily just, is it a recession year? Is it or is it not a recession year? But it's also what we know for sure is that it's a presidential election year, right? And to what extent would that constrain the Fed's moves? Would they be more or less likely to hike or cut, given the pressures that they're certainly going to be facing, at least from the person who is right now the leading Republican presidential candidate, who's saying that that Powell should cut rates, and in fact, Powell should cut rates and then leave the job because Trump doesn't think he should be in it.
Yeah, it'll be very interesting to see how the market reacts next year when the candidates, when the two nominees are really out on the campaign trail and comparing their economic programs. And as you said, assuming that the Republican nominee is former President Trump, he is a low interest rate, tax cut kind of guy, and that was kind of what markets wanted at the time when he was, 20. That was a lot easier to sell to markets in 2016, 17. Nowadays, when you've got maybe the, bond vigilantes aren't fully galloping across the financial market landscape yet, but we saw some pretty significant pressure on Treasury markets in October, and a lot of attention on deficits and supply and that sort of stuff. And so the idea of the fact that if President Trump is elected and gets his way, would that be an inflationary comeback, right? If he's cutting taxes and slashing and putting in, an easy money Fed, then, we all saw what happened to Liz Truss, right? Like short-lived UK prime minister who came in with a set of policies that weren't insane. They were just totally wrong for the financial market context. And the gilts market absolutely just rejected it and sent her packing, essentially. Financial markets did it more than anything else. The response was swift and terrible, and that was the end of her and her policies. And not saying that that's going to be a repeat here, but that's the kind of thing that you have to pay attention to. A second Biden term, good question, right? Bidenomics, it would be, essentially the sort of finish the job, I guess, would be, that's always that's always kind of the mantra for a second term, right? Put me back in and I'll do, even more on the, the infrastructure side and, modernizing the economy and, bringing manufacturing back and all that stuff. But it's not clear that there's really going to be all that much that's really new in the Biden economic platform. We shall see.
John, I had almost forgotten about Liz Truss and the head of lettuce. So thank you for that throwback. I appreciate it. So,
yes, that'll be a trivia, Liz. That'll be a trivia question. For
how many days did the head of lettuce last, and how many days did Liz Truss last? Right.
Yes, that's right. Name the UK prime minister who was outlasted by head of lettuce. Yes, now you will remember.
Yeah,
Liz
when
Truss.
I'm on Jeopardy, I'll split my winnings with you, John. So we're looking pretty far ahead here, all the way to what the Fed might do at the end of 2024. But at least for the upcoming Fed meeting, it seems like the course of action is pretty clear. Markets are expecting the Fed will hold steady, and it seems like the Fed will comply. What are you guys looking at for the week ahead beyond the Fed meeting?
So we get the inflation numbers before the Fed meeting. So the CPI will come out. And later in the week, we get retail sales. And then also we get a lot of global PMI data. So and along with that, we also get the Bank of England and the ECB. So next week is a dream week for a macro dork.
Which all of us are, proudly.
Backward.
Great. Well, we will talk more about it next week. That does it for us here at the Macrocast today. I'm Ylan Mui with Penta. My co-hosts are John and Brendan of Markets Policy Partners. We hope that you enjoyed our show. And remember, you can always listen, like, and subscribe to the Macrocast wherever you get your podcasts. Thanks for listening.